Good afternoon. Thank you for joining the Venture Carolina Crowdercast for this afternoon. We have scheduled the next hour to talk with you about the valuation of early stage companies. My name is Matt Dunbar, and I am one of the managing directors of the South Carolina Angel Network. And so I'm here to talk with you today about how we think about valuations for early stage companies when we are considering investments in those companies. So let me start by saying thank you for your time this afternoon. I have prepared a few slides that I'd like to share with you for the first 15 minutes or so of the next hour. And then from there, we'll take your questions and spend as much time diving into those topics as you would like. To point you to those slides, if you'll scroll down into the description of this session, in the very last line, you'll see a link to our website, which is scangelnetwork.com. If you'll go to that site and then type in /resources, you'll come to our investor resources page. And near the top of that page, you will see that we have 3 topics listed there for various Crowder sessions, 2 of which have already happened, and the third of which is this one for today on valuation of early stage companies. If you'll click on that link, you should be able to pull up some slides that I will use to guide our discussion in this first portion. And then once again, we'll be happy to take your questions from there. Let me also mention a couple of other things. If you will go to the first slide in that deck when you get to it, or the second slide, I should say, let me briefly introduce Venture Carolina and the South Carolina Angel Network. The South Carolina Angel Network is a group of about 8 or 9 angel groups in and across South Carolina and Western North Carolina that comprise 200 different early stage investors who work together to source and screen and select and invest and support various early stage companies in our ecosystem, primarily in the Southeast and with a bias for the Carolinas. We've been doing that for the last 8 years or so and have invested about $17 million in 48 companies over that time. And so we have seen a lot of companies and seen a lot of valuations. So we hope that our experiences will be helpful to you in our discussion today. As part of the South Carolina Angel Network, we created Venture Carolina, which is our nonprofit arm that focuses on education. In a market like ours, where we haven't historically had a tremendous amount of startup investing activity, we think it's important to try to bring both investors and entrepreneurs to the table and provide educational resources for both sides of the market. So for folks who have not done this before, you'll have better insight into how to think about early stage investing. Again, if you're an investor, how to think about pricing early stage opportunities appropriately. And if you're an entrepreneur, to gain the perspective on how to approach investors and give yourself the best chance of success in raising money. So Venture Carolina is our nonprofit arm. That's the vehicle through which we are presenting to you today. And then finally, the platform we're using is a company called Crowder, which is one of the most recent investments that the South Carolina Angel Network has made. Crowder was conceived as the very first crowdfunding platform that incorporates live streaming. So you can see that we're live streaming now. Crowder is the first crowdfunding platform to incorporate that, in addition to allowing you to make charitable donations even during this event. So if you'll look towards the bottom of your screen, you should see a button that would allow you to contribute to the cause if you were so inclined. Any donations received today will go into the Venture Carolina entity, which will be used for further educational events for, again, entrepreneurs and investors. But stay tuned for other upcoming events on Crowder. I think you'll certainly see a lot of politicians using the platform during this campaign season, as well as other nonprofits, and also the South Carolina Angel Network and Venture Carolina. We have another Q&A session coming up in May. We hope you'll tune in for that, and that will be a general open session on early stage investing and give you a chance to ask any questions you might have about investing, either as an entrepreneur or as a potential aspiring angel investor. So that's my introduction for today. Let me again say thank you for your time. If you do make a contribution, we would certainly appreciate that. And I believe we have seen one contribution come in from Rodney already. So thank you very much, Rodney. We appreciate that very much. Again, I want to begin our session by walking through some slides to tee up a framework for how to think about early stage valuations. So I'm going to start with those slides, and then again, once I run through those, we'll open it up for Q&A. So on slide 3 of the deck, if you have managed to find your way there, again, it's on our website, seangelnetwork.com/resources. You can find the slides there if you haven't already. The question that everybody has for early stage companies is, how in the world do we know what an early stage company is worth? And the short answer to that question is the same answer as practically anything else that you want to put a price on. It's worth exactly what someone is willing to pay you for it. So that's sort of a technical answer, but it's accurate, but also doesn't really help you get to the answer of exactly how much you should ask for when valuing your early stage company. But it is instructive to begin thinking about it from the perspective of the buyer, in this case, the investor, or potentially at some point an acquirer for your business. So if you're an entrepreneur, you really want to get in their head and understand how they think about valuation. So that's what we're going to lay out here over the next few minutes. So if you go to the next slide, another way to think about valuation is from a theoretical standpoint. A technical way to value a company would be to look at all the future cash flow streams that that business would generate and discount them back to the present day based on some appropriate discount factor, which in the case of a startup would be a very high discount factor because, of course, startups are notoriously risky and more likely to fail than to succeed. And so we would use a very, very high discount rate. And we would also have to think carefully about what those revenue projections look like. Certainly, most startups tend to present hockey stick type projections that anticipate wonderful, optimistic outcomes and doubling and tripling revenues year over year, which of course happens, but happens much more rarely than entrepreneurs predict that it will. And so if we were trying to do a cash flow model on an early stage startup, we could plug in some assumptions, but they wouldn't be grounded in a whole lot of reality because we just wouldn't have much experience or history with the financials of the business. So who knows what the appropriate discount rate or the appropriate future revenue projections or cash flow projections would look like for that business. So it makes it very difficult to get a precise discounted cash flow type valuation for an early stage company. So we're left to wrestle with other alternatives. We have to guess at it, we have to estimate at it, triangulate on it. And so it turns out that it's much more art than science at the end of the day. But we do try to bring a touch of science to it, and we try to be artful about it as well. So let me give you a quick primer on some terms. If you haven't spent much time thinking about this before, these will be helpful terms for you to know. We'll be referring to these throughout our discussion. Some of you will know this already, of course, but just to make sure we're all on the same page. One of the questions that you have to think about when you're thinking about valuation is, are you talking about the pre-money valuation of the company or the post-money valuation of the company? The pre-money valuation is essentially what the company is worth right before the investor puts their money into the company. And so one way to think about that would be how many total shares of the company are outstanding before the investment. And if we apply the new price that we're about to sell those shares for when the new money comes in, that would give us a calculated pre-money valuation for the company. The money, of course, would be the investment, the dollar amount that the investors are going to put in. And usually, if we add the money to the pre-money, we would come up with the post-money valuation, or what the company is worth right after the investor puts their money in. And in simple cases, that math works clearly, the algebra adds up. But in some cases, it gets more complicated, and we'll talk about this briefly. But if you have convertible notes or options or warrants or things like that, it can complicate that math. And so it may not be the case that pre-money plus money equals post-money in those cases. But for now, let's keep it simple and assume that there's no complicating factors and that an investment would represent the money in this equation, and the pre-money plus the money would be the post-money. And again, another way to calculate that would be the total number of shares outstanding after the investment multiplied by the price at which you sold those shares. So again, I'm sure most of you are familiar with that terminology, but just in case, I wanted to lay that out for starters. So let's briefly walk through some valuation methods, give you a sense of some of the art and a little bit of the science that investors use to think about early stage valuations. And then again, we'll open it up for your more detailed questions. So there are three sort of types of methodologies I'm going to talk about today. One is a heuristic methodology, which is sort of a rule of thumb. What can we use as some sort of rule of thumb to think about valuations? The second bucket will be some simple scorecard methods that have been used quite extensively. And then the third is probably the most scientific approach that we think about, which is the so-called venture capital method. So in the heuristic bucket, the first thing I'll point you to is something called the HALO report. This is a study that's put together quarterly by the Angel Resource Institute, which studies this market extensively. Each quarter they publish a set of data that shows you across the country how valuations and investments are trending in the early stage space. So what I'm showing you on slide 7 of the slide deck, if you are following along, is a snapshot of valuation trends. This is from the 2015 report. So you can see side by side 2014 and 2015. You'll notice a massive increase in the median valuation for early stage investments among angels and angel groups, a 50% increase from 3 million to 4.5 million. And I'll come back and comment on that in a moment. But this at least gives you some data you can look at and say, as a rule of thumb right now, early stage ventures are getting valuations in that 3 to 4 million range. But let me caveat this data for you with a couple of important things to keep in mind. For starters, this information is not broken down with any granularity across regions, at least currently. We hope that in the future that data will be available, but these are national averages, so certainly some of those valuations are skewed by very hot venture markets like the West Coast and maybe the Northeast. So if you're in the Southeast raising money, you have to discount these valuations some because capital here is more scarce, and because it's more scarce, it's more expensive to you, the entrepreneur, which means the valuations tend to be lower. So you can't just pull this headline number off the HALO report and expect to get this kind of valuation for an early stage company in our region. Another thing to keep in mind is that part of the reason for that massive increase in valuation year over year is colored by what's happening in the broader venture markets. If you pay attention to venture capital, you know there's been a massive influx of venture capital, or there was over the course of 2014 and 2015, particularly at the late stages, and it drove valuations up pretty significantly, which had a spillover effect at the early stage as well. But we've already seen that expansion begin to cool pretty quickly, and we've seen some venture dollars pull back and valuations start to come back down. So I think in 2016, at least the first half of 2016, you'll see that valuation number come back down closer to the longer term average, which is closer to that $3 million number that we saw in 2014. Another thing to keep in mind is some of the deals that get reported here are not necessarily the early stage deals that an angel would initially invest in your company. They may be second and third round investments by those angels. So there's a little bit of later stage data in here that also increases the valuations. So keep those caveats in mind, but this is a place to start to look at some benchmark data, some heuristics on how other companies are valued. Another rule of thumb is just to think about how much equity an angel investor wants to own when they invest in your company. So again, these are rules of thumb, so there's lots of cases to be made outside of these bounds, but generally speaking, angel investors who are putting the first outside money into your company would typically expect to own about 20 to 30% of the equity in your business for the entire angel round. So for instance, let's just do a quick math example to make that clear. If you're raising $500,000 for your venture, let's assume the angels want to own 25% of your company in exchange for that $500,000. So we can calculate the valuation, the post-money valuation, which is I've represented on this slide is V post. So the post-money valuation you can calculate by simply dividing the $500,000 by the 25%. So you come up with a post-money valuation of $2 million. And so we can check our math and say, okay, if they put in $500,000 of money into a post-money of $2 million, that means that they own 25% of the company. And so in this case, the math is simple. We can back into the pre-money valuation by simply subtracting the money from the post-money. So if it's a $2 million post-money and the money itself was $500,000, then that will leave us with a pre-money valuation and subtract the $500,000 from the $2 million of $1.5 million. And in most cases, when you're negotiating a price for an investment from investors, you're thinking about the pre-money valuation. So most investors and most entrepreneurs, when they're talking about valuation, will be talking about the pre-money valuation. So in this case, an entrepreneur would say, I'm raising $500,000 on a $1.5 million pre-money valuation. Therefore, the angels would own 25% of the company after their investment. So again, just a rule of thumb, if to keep in mind that generally speaking, for an early stage company that's pre-revenue or very early in its revenue, that you should expect angel investors to want to own 20 to 30% of the equity in the business. And so depending on how much you want to raise, it can help you get at the right valuation number to go to market with. Again, just remember that if you're converting convertible notes or you adding option pools and thinking about warrants and other things, that can skew the valuation a little bit. You've got to account for those things, and so it can actually drive your post-money valuation up quite a bit if you have those additional complicating factors in the mix. Don't want to spend too much time on that at the moment, but just be aware that that's a possibility. Next, I want to talk about scorecard methods, and I'll be quick on this. These are simply ways to go down a checklist of different factors that you might like to see in a startup and assign a certain value to those factors and add them up. So a very prolific, prominent sort of godfather of angel investing in the U.S. is a friend of ours, a guy named Bill Payne, who's done wonderful things for angel investing as an asset class over the last couple of decades. Bill came up with a checklist that you see here. It's been used by the Kauffman Foundation quite a bit. Bill did some work for the Kauffman Foundation years ago and effectively came up with some categories that you could go down the list and plus or minus based on the strength of the team and the opportunity and the market, and assign a certain value to those things. And you would assign that in the band of valuations you'd expect for an early stage company. So in our market, we might expect that an early pre-revenue company is somewhere typically going to be valued between $1 million and $3 million or so, maybe $4 million. So we put bounds on that, and then inside those bounds, we can adjust up or down from the median based on the strength of these categories. So it's very simple, very quick, very flexible, but certainly you could debate what's the right valuation band and what are the right weightings to assign to each category. But again, as a simple, quick way to get at trying to think about evaluation, this is an approach that sometimes investors will use. Dave Burkus is another very prominent angel investor, also from the West Coast, who's had a big impact on angel investing and been quite successful at it. He uses a similar method, maybe even more simple than Bill's, where he's got 5 categories that he's assigned a $500,000 valuation to each category, and he'll add those up. And so that would get you to a quick, quick and dirty valuation based on those factors. So you can look these guys up, Bill Payne and Dave Burkus. They both got great websites and are both good dudes. And so it's worth spending some time reading some of the things that they've posted and written about over time. So again, very simple, very quick, easily debated, but useful places to incorporate into your triangulation on valuation. Then finally, let me mention the venture capital method. Again, this is probably the most scientific approach that we would think about in terms of valuation. And there's a couple of factors that we want to think about in terms of getting at the venture capital method. And I'll go through the math here in just a second. But the core idea is that we're really thinking forward and thinking about the end game and then backing into a valuation today. So what I mean by that is that the investor is going to look at the opportunity and say, as an angel investor, I know I'm participating in a very, very risky asset class. And so I need to generate a very high return on my investment in order to make it worth the risk that I'm taking. I know that half the things or more that I invest in as an angel investor are probably going to lose money. So the ones that I bet on that win have to be able to win big enough to make up for all those losses and give me an appropriate risk-adjusted rate of return of, say, 20% or more. Well, if I want a 20% rate of return in this asset class, I can't bet just on opportunities that can generate a 20% rate of return, because remember, most of them are going to turn out to be zero. So if I put some 20s with some zeros, I'm probably going to end up at a 10% rate of return, which I can get from the stock market with much less risk. So I've got to drive that return up significantly as an angel investor. So I need to bet on opportunities that can generate a 50% rate of return. That's sort of a nominal starting point that a lot of angel investors will think about when they're evaluating an opportunity. Is this startup, does it have the potential to generate a 50% rate of return for me? If not, it's probably not worth putting into my portfolio. So how do we determine if we can generate a 50% rate of return? Well, now we have to look at the numbers. We have to think forward to what we think the exit could be. What could this, if we liquidate this company in a few years to an acquirer who comes in and buys it, which is our typical exit strategy, what would it be worth? And in order for me to generate my 50% rate of return, what would I have had to have paid in order to generate that rate of return? So let's walk through an example and maybe that will become clear. So if the angel investor is thinking about investing $500,000, they look at the business and think, okay, for this kind of business, we think that we can grow it to a substantial size that would be attractive to an acquirer in 3 to 5 years. And more often than not, it takes longer than we think it will or should. So let's assume it's a 5-year exit horizon for a company. And as an angel investor, again, remember my required hurdle rate or rate of return is to bet on things that can generate a 50% rate of return. So if I think it's going to take 5 years to exit this investment and I need a 50% rate of return, if we do the math, that turns out to be about a 10x return on investment. So I need to make 10 times my money in 5 years to generate a 50% rate of return. That's just a time value of money calculation. So if I want to generate 10 times my money in 5 years to get that 50% rate of return, that means I need to turn my $500,000 investment into a total return of $5 million, or 10 times my investment. So the bogey I've got to cover or believe that the investment could generate for me as an investor is $5 million outcome on a $500,000 investment. Okay, so now let's look at the business. Let's say the entrepreneur has presented us with a pro forma that suggests that they're going to be doing $20 million of revenue in year 5. And let's say, for the sake of argument, that while we love our entrepreneurs' optimism, we're going to take a more conservative view and expect that rather than $20 million in revenue in year 5, the company can generate $10 million in revenue that year. But it's a good growth story, and let's assume that other transactions in the marketplace suggest that companies in this particular space have been trading or being bought by big strategic acquirers for something like 2 times revenue. So if a company was bought for 2 times revenue on a $10 million revenue run rate, then that would suggest the company would exit for $20 million. So if the company exits for $20 million and I, as the investor, need to get $5 million of that to generate the required rate of return that I set for myself, then I need to be able to capture $5 million of that $20 million, or 25% of the value of the company. So now, if I know that in the future I need to own 25% of the company to generate the required rate of return, well, then I can back that up in today and say, okay, well, if I'm putting in $500,000 today, I need it to represent 25% of the company so that I get the 25% share at the end of the day and generate my $5 million return that I required for this investment. So if I'm putting in $500,000 today and it's worth 25% of the company, we're right back to the math we showed on the previous slide. The company post money is worth $2 million today, and my $500,000 represents 25% of the equity in the business. So again, we calculated a pre-money valuation of $1.5 million. So again, a little more science, a little more math, not terribly complicated. Hopefully that those numbers made some sense. Again, it gets more complicated if we add other things into the mix here. This also is not currently accounting for future dilution. So in most cases, we know that we're going to have to raise money again between now and the time the company exits. So a smart investor will factor that into the math and calculate that dilution. And in this case, if we knew that in a couple of years we needed, or say 18 months, we needed to raise another $1 million, we would factor that in and actually have to come up with a lower pre-money valuation to hit the same target rate of return, because we know there's other money that's coming in after us that also requires a return and will dilute some of that $20 million that's coming back to the company in year 5. And that's just some spreadsheet math, and we can provide some of that material to you if you have any questions about that. Lastly, let me say a quick word about convertible notes, and then we'll move to the Q&A. A lot of times entrepreneurs come to us looking to raise money with convertible notes, and I'll just tell you off the bat that in most cases, we as angel investors don't like those, and I'll give you a few reasons why, although I could give you some more. And the point typically of coming to an investor with a convertible note is to avoid the hard conversation about valuation. Who knows what the company's worth, so let's try to avoid the conversation altogether. Well, that may be okay in certain circumstances, but we think in the long run it's worse. It's a worse approach for both investors and entrepreneurs for a few reasons. Typically, what we've seen in our experience is that those convertible notes, which are often referred to as bridge notes, don't actually bridge to anything. It becomes more of a pier than a bridge, and we're not clear about what's on the other side. So unless we have a very clear view in the near term of what's going to convert that note or that debt instrument into an equity ownership stake in the company, we're not really comfortable, because what happens is if we don't know what's on the other side, and we've got a lot of uncertainty between here and there, then the chance of converting my debt into equity at a price that's reasonable for the risk I took at that early stage is pretty unlikely. So over time, it becomes harder and harder to price the company when the conversion does happen at an appropriate level for the risk that the investor took when they first invested in the company. So in most cases, without a very clear horizon, like an acquirer who is really interested in buying the business, and this is a bridge to really get to that acquisition, or a bigger later stage investor who's very interested in the business, and we expect them to come in the near term and price the round appropriately. In the absence of those things, we're not likely to be intrigued by a convertible note. And what happens ultimately is it just makes it hard for the investor to generate the appropriate rate of return for the risk they're taking in that early stage company. There's some other reasons about misalignment. When we get to the next stage of investment, if I'm a debt holder and you're an equity holder as the entrepreneur, we can be misaligned on how we want that next round to go, which can create some problems, particularly with your board. It also is unfavorable from a tax standpoint for an investor, as when that interest earned on the note converts into equity in the company, that's a taxable event to that investor at the time of the conversion. And as a startup, you probably don't want to send cash out the door to pay your investor's tax bill. So that's a sticking point. And then perhaps most importantly is for an entrepreneur, the longer that debt stays on your book accruing interest, particularly if you assign a reasonably high interest rate to it, it can really start to make your balance sheet ugly and really get problematic for trying to get future deals done with investors or acquirers. So it can really cause complication and barriers to what you need to do in the future if you have this big accruing debt sitting on your balance sheet. Those are just a few reasons why we're not big fans, but again, in certain cases it makes sense. A couple of our best investment returns to date have been from convertible notes, but the reason we did them was because there was a very near term, very clear horizon to what that was going to convert into. And the terms made sense, and we were able to do it in those cases. But just as a general rule for your first round of funding, when you really don't know what's going to happen next, we would much prefer to be equity investors rather than note holders. So don't be surprised if investors push back on convertible notes. I've talked longer than I meant to, so I apologize for that. So we can go a little bit long with your questions if we are not done by the top of the hour. But I do want to thank you for your time. I hope this has been a helpful discussion. But now let me get back to the questions here, and I see several questions here, so thank you for submitting those. I will just go right down the list. So I'm going to start with the first question. I'm a rookie at Crowder, so give me just a second to see where this first question is. Okay. If the Southeast, this is coming from Thomas, if the Southeast has the lowest valuation averages and the lowest SPR grant rate, what advantage does the Southeast have to stay competitive? So you've raised a big macro question, certainly a good question. I can't quote the SBIR rates off the top of my head, but I wouldn't be surprised if we're low relative to some other places. But I think there's a lot of advantages in the Southeast. I think, for one, quality of life is great. We hear that all the time. I think cost of production is lower for startups, so you can get access to talent. Because we have a great place to live, we can attract talent based on quality of life factors that you might need, and pay them less in this market than you might be able to in other regions. So I think you can get access to talent, and there is world-class talent here in the Southeast. Maybe it's not on every corner like some other places that are famous, but there is great talent here, great quality of life, lower cost to acquire that talent. I think increasingly you do see capital formation getting stronger here. And I think you see people coming into this market because they see it's an untapped, underserved market. And so opportunities are there. But I think there's a ton of great reasons to be in the Southeast. I think there are lots of organizations and partners that are working to make it a more attractive place to stay and grow startups. Certainly capital access is one of those factors, and we have a long way to go, but I think we're making steady progress. And if you find the right partners in our ecosystem, I think certainly we've had lots of companies that can be successful, and I think we'll see more and more of that. I am going to try to move to the next question, but clearly I've got, again, as a rookie, I'm not immediately able to advance to the next question, but I think I can scroll down and get it. So apologies for the user error here. The next question I see is from Caroline. As an entrepreneur, how can I get prepared enough to negotiate valuation with professional investors? I think the answer to that is always to do your homework as best you can. Really try to get yourself in a position where you can understand where the investor is coming from, put yourself in their shoes, approach the discussion with an understanding of how they're likely to approach the discussion. So I think doing things like this and reading up on blogs and tons of resources out there for entrepreneurs to think about how to approach investors. Those are all worthwhile. Just off the top of my head, a great place to start would be Brad Feld and Feld Thoughts, his blog, and also a book that he and a partner have put together called Venture Deals. I think it's really important for entrepreneurs to understand beyond the valuation, what are the other terms involved in an early stage deal, and what are you signing up for, what are your obligations, what are your risks. Really understand how that impacts you at the end of the day in terms of what controls investors will place on you, and ultimately what kind of how the proceeds from an exit would flow to you, and those can be impacted pretty significantly by the terms. So read Venture Deals, read blogs, and I think that that will help you get prepared to enter a discussion with investors. So again, do your homework and really understand how they are likely to approach the conversation. Let's see. Marcus asks, in your experience, do you think early stage companies tend to be overvalued? We certainly do see a fair bit of that. I think it depends on who the investor base is. Again, since we haven't had necessarily a super robust ecosystem for early stage investments in our region, we have seen a number of companies that maybe have raised money from friends and family who haven't done early stage investing as much. They're not as concerned about valuation for obvious reasons. They're really just trying to support their niece or son or daughter or whoever the case may be. And so we do see some inflation in valuation from that standpoint. We also see entrepreneurs that read a lot of the West Coast blogs and see what's happening in that market and come with overblown expectations around what valuation should be at the early stage. But we also try to bring some discipline. That's part of the value we add at the South Carolina Angel Network, is to give investors a place to come and have some rigor and discipline about how to think about that again, because if we don't generate attractive venture returns in this asset class, investors will stop coming, and that's bad for our ecosystem. Obviously, we need those investors to be there, so we need to generate attractive returns, and we have to be careful about valuations in order to do that. So we do tend to see certainly aspirations that would be overvaluing a company, but we try to be disciplined about the price at which we ultimately invest. Let's see. What are some criteria used for valuing a service-based company that has few assets and not yet generated positive cash flows? And this is from Marcus. Thanks for the question, Marcus. I'd say largely what we've discussed would apply to either product or service type business. Certainly, I think you'd expect most of the things that investors are looking at to be product businesses. But regardless, I think the economics of the business will help dictate how the valuation lands, and at the end of the day, what kind of exit or monetization event the company can generate. So in a service business, typically those businesses don't scale as well as product businesses in terms of particularly when you had a people-heavy cost base, it's harder to drive improvements in your margin as you grow, unlike some product companies, particularly software companies. And so that can make the unit economics a little more challenging. It can make ultimately the multiples that people are willing to pay at the end of the day a little more challenging. But you can still take those parameters around that type of business, plug them into the venture capital model, and come up with an appropriate valuation. So I think it just depends on all the factors we've talked about, and ultimately coming to a conclusion about what price could generate the kind of return an investor is looking for. Certainly to the extent that you can look at other companies that have exited in your space, that's a big part of the homework you can do as an entrepreneur to get an investor more comfortable making the investment, showing them other companies like yours that have generated multiples that are attractive. To the extent that you can give them that data, I think it will help you in those negotiations. Next from Thomas, which 5 states would you say have the highest valuation averages? Again, I don't have the granular data, but I certainly think you would expect it to be all the hot spots. So certainly California is going to be at the top. I think Massachusetts and New York would be right there neck and neck, probably behind them, but would be the next 2. And then from there, it would probably be, if I had to guess, a combination of places like Washington, Texas, and other sort of states that are close by those hotspots. Those would probably be the ones that I would guess at right off the top of my head. Let's see here. Sorry, folks, still trying to get my question flow working here. Bear with me 1 second. All right, sorry about that. Can you share the range of valuations at which SCAN has invested in the last year? And this is from Carolina. That's a great question. Off the top of my head, I would say the range is probably as low as $1 million, and I would say it's probably as high as $10 million. But the $10 million are companies that are not pre-revenue. They're into their they've got several $1 million of revenue and are raising later stage growth capital as opposed to early stage pre-revenue type capital. So I'd say the sweet spot for us tends to be sort of 1 to 4 for most of the investments that we do. But again, we can do some later stage deals as well, and so we have done some that are a little higher. But first round investments would typically be 1 to 3 or 1 to 4, and we've seen that range over the last year for sure. All right. Thomas asks, SC has SC Launch. What other states have similar programs? And would you say SC Launch is comparative? What states have the best programs? Good question, Thomas. I can't speak from, I'm not intimately familiar with programs in every other state. I certainly know there are some out there that do a great job. Pennsylvania has a great program through Benjamin Franklin Technology Partners. Ohio has tremendous programs through the Third Frontier program. Every state is doing something in this space, and they all take different flavors and approach it in different ways. And I think SC Launch is a little unique as well. So lots of states are doing lots of different things. I'm certainly not an expert on that, so it's hard for me to give you a ranking, so to speak. But I'd say SC Launch does a great job. It's great to have them in our market. They've done a lot of great things to help early stage companies. So certainly a big plus that SC Launch has been doing what they've been doing over the years. And I know there's an effort to grow it, which we think would be great. Anything we can do to increase access to capital here in South Carolina is a win in our book. And so we'd like to see that. And of course, we'd like to see more angel investor tax credits. In addition to that, we got that passed a couple of years back, and it's been a very effective tool. So we're hoping that we can make the case to the legislature that along with SC Launch, that the angel investor tax credits are another great tool to entice more capital to come into the market. So sorry I can't give you a direct answer, Thomas, but I'd look at places like Ohio, Pennsylvania as some that come to mind with great programs. Wisconsin's done a good job as well. Follow-up from Thomas, many states offer pro bono programs and they get real experience or get resources they wouldn't otherwise be able to afford. I don't know. There are a few programs that you might come across that may be pro bono at different markets will do different things. Those tend to be a little bit more localized. So for instance, in Greenville, we have a couple of different programs that are partnerships between places like Clemson University and some of the local law firms to put on a series of seminars to give folks exposed to early stage practices, best practices, and how to think about approaching startups. You've got things like I'm trying to think, the names are escaping me at the moment, but other local entities will put together programs like that. The Kauffman Foundation has the Fast Track program. I know it's been put on across the state in various venues at various times. I'm not sure that's completely free, but I think relatively low cost. So you have to do a little hunting and pecking to get at where some of those opportunities are, but I do see an increasing number of entrepreneurship programs. A lot of times they are associated with universities, but some of those programs can be really valuable. So I'd encourage you to look for those as ways to try to get access to some free content. Let's see. Can you think of any contests where the winner receives free resources to help their startups get off the ground? Yeah. So I can think of one that's very top of mind this week in Charleston was the Dig South event. Some of you are probably familiar with that. Events like that one will often have pitch competitions, and there can be various kinds of prizes related to those events, whether it's cash prizes or a suite of services that can be made available, whether it's IP assistance or websites or marketing. All those types of things are often parts of award packages for folks that win those startup competitions. So, and there's no shortage of those. So particularly again, around economic development organizations, around universities, around big events like that, it's worth paying attention to those pitch competitions and looking for resources that might be made available through those programs. So I'd encourage you to look there. Again, I apologize that I'm not able to make the questions flow quite the way I thought I would here, but there's a question here: is it possible to put a specific value on patents or patent applications? The short answer is no. Again, they're going to be valued differently by different parties depending on what their need for that technology is. It might be a patent that is really strategic to a particular company, and that might be really valuable to them, whereas it might not be as valuable to another player that doesn't have the same suite of technologies in their portfolio. So really difficult to say. Certainly early stage investors want to understand what your defensibility is from a patent standpoint, but we don't necessarily assign a dollar value to those patents. It's part and parcel of the overall evaluation of how strong the opportunity is, and can certainly help the valuation, but it's hard to assign a particular dollar value to that. In some cases, patents may or may not be the right approach to defensibility. Certainly when you issue a patent or file an application, over time that information becomes public. So in some cases, we actually prefer not to see patents so we can keep things as trade secrets. In other cases, we think depending on the market you're operating in, patents might be extremely valuable to carve out space and to give you a hook to try to attract acquirers who are very driven by acquiring patents and technology. So sorry to be wishy-washy, but it's hard to assign a particular dollar value to patents, I would say. Next question here from Paul: can you talk about the valuation of family and friends rounds, how family and friend valuations might impact angel investing terms? Yeah, the biggest problem we see is that if you overvalue the company at a friends and family round, so for instance, Aunt Sally wants to put 50 grand into your company, and that's great. But let's say if you think your company's worth $5 million when she puts her $50,000 in, well, she's gotten a small piece of the company. But if you now come to an angel investor and they look at your pre-revenue company and say, you're really probably only worth about 2 at this point, now you create a situation where there's a so-called down round for Aunt Sally. So whereas on paper, her stock was worth $50,000 when she put it in, if we think you overvalued the company by 2x, we're going to negotiate a share price that's half of what she paid. Then on paper, her investment just got cut in half. And so her shares on paper would be worth 25K instead of 50K, which is not a very fun conversation to have with Aunt Sally. It gets a little messy just putting the paperwork together on that. And depending on how you structured the original deal, that can be problematic. And frankly, in a lot of cases, something we don't really want to, as an angel investor, we may not want to deal with having to clean that up or have those conversations. And so we might just say, you know what, we're just going to move on and look at other opportunities because this one's just structured in a way that makes it difficult for us to come in cleanly and start off on the right foot. So that's probably the biggest thing is overvaluation. But there can also be structural issues. Sometimes we'll see folks use maybe a family friend or somebody in the family who's maybe a real estate lawyer, doesn't really know corporate law or securities law. That can also get problematic by really missing or stubbing your toe on some of the legal paperwork and structure that needs to be in place. So one piece of advice would be to make sure you get a good securities lawyer when you're putting together an investment. Hard to write those checks when they're charging, a couple $100 to a few $100 an hour early on, but you really want somebody that knows what they're doing from a securities law standpoint, so you don't shoot yourself in the foot. An increasing amount of risk for startups with new rules around crowdfunding and what's called general solicitation. If you're out there talking about raising money, you can really get yourself in a world of trouble. So you really got to be careful. So we'd advise you to get good legal counsel. Let's see, I'll move down the list here. Would you have any advice for early stage companies to pay professional valuation consultant? We wouldn't advise that. Again, we think with the fact that it's art more than science, if you're paying for a valuation, you're overpaying for something that you really can't define other than the way the market is going to agree to invest at a certain valuation. So we think that that's probably not a great idea. I think when you're a later stage company and you're issuing options at that point, valuations are important because you got some regulatory things to worry about in terms of how you price those options. But when you're early stage, pre-revenue, we would not advise you to hire a valuation consultant. We think your cash should be spent better elsewhere and using tools like the ones we provided today to help you come up with a reasonable approach to valuation. Let's see. I was told Ben Franklin, Thomas asked, I'm told Ben Franklin Technology Partners was SC launch like, but offered up to $100,000 for seed money to help startups. I'm not 100% sure, Thomas. I do know that they're active in the space, and I think they are SC launch like in some ways, but I don't know the particular parameters around what they can do. I know SC launch can do up to $200,000 for companies, but I'm not sure about Ben Franklin. But I'm sure if you spend a little time on their website, you could probably get an answer to that, but I don't know off the top of my head. Sorry about that. Let's see, scrolling down. Let's see. Do any universities here offer free web hosting services? Again, I'm sorry, Thomas, I don't know the answer to that. I'm not aware of anything like that, but I don't know for sure. I do know that there are a number of shops out there that can do web hosting for relatively small amounts of money, but I don't know about a particular offering from any of the universities. Sorry about that. Next question from Thomas: are there any webinar-like sites where startups can pitch online, so lots of groups can to even the playing field? Probably the closest thing I can think of, Thomas, if I'm following your question, is there are a huge proliferation of sites that are so-called crowdfunding sites or investing platforms. And there's two types of those. There are sites like AngelList and a bunch of others that would put your investment opportunity in front of a universe of what are called accredited investors. So the angel investors we deal with are folks that have to meet certain income or net worth thresholds established by the Securities and Exchange Commission. And by only selling securities to those folks, we can avoid a lot of regulatory hurdles that we would have to jump through if we were doing more of a public offering, where folks might not have the financial wherewithal to take the risk of an early stage investment. So we focus on just accredited investors. There are platforms out there that do the same thing. So it's a web portal where you can get your deal in front of lots of accredited investors spread out across the country and across the world. So they're not just local to our area. There's a bunch of those out there. There's Seed Invest and Funders Club and a lot of those. So you can explore those. AngelList is certainly the granddaddy, but you can explore those as ways to get your deal in front of accredited investors. And then on May 16th, there's going to be some new federal rules in place as a result of the Jobs Act from 4 years ago now, that will allow equity crowdfunding. So folks who are not accredited will be able to buy equity in companies, again, through vetted portals that are regulated by the SEC. So there are portals now that have been getting their ducks in a row to be able to do that. So that's another way you can raise money sort of from a broader set of folks, and there'll be some, I'm sure, that are focused on the Southeast as time goes on. We would give you a word of caution there, just to be really careful about that, because there are 600 pages of rules that have been published and easy to get sideways and mess it up and cause real problems for yourself and your investors if you don't really pay close attention and do it right. So again, securities law is helpful. These platforms there are going to be a lot of them that aren't really as good as they claim and don't do a good job, and you want to be careful with the risk you're taking as an entrepreneur before you rush into that. Hopefully when the dust settles, we're going to have a more robust marketplace and it's going to be good, but I think in the short term there's going to be some fires to put out and some people get burned by it until we kind of get a little bit more comfortable with how it should work. And unfortunately there'll be some pioneers that take some arrows in the back, and so I'd suggest you try to avoid that. It's certainly worth exploring and keeping an eye on. Let's see. again, I've not figured out the best way to manage the question flow here. But it looks like I think I've covered all the questions that I can see. If there are any more questions that I haven't answered, maybe you can resubmit that and see if it'll pop back up to the top for me. All right. I'm going to direct this question at my colleague, Paul Clark, who I think is listening in. Paul, I think I've exhausted the questions I can see. If there are others, maybe you could enter another question to direct me to make sure I'm not missing anything. But as far as I can tell, I think I've answered the questions that I'm able to see. All right, I think I see two more here. As a startup, what events would you recommend attending to network? I think certainly getting out and being in the mix is really important as an entrepreneur to learn not only on the investment side, but also just from learning from other entrepreneurs and sharing war stories and helping navigate marketplaces and talent and all those things. That's really important. And so I would suggest that you go to any of the events that you can find in your local area where entrepreneurs are. Certainly, there are different organizations in different places that help facilitate a lot of those. Here in Greenville, we've got Next. In Charleston, I know there's a digital corridor. You've got accelerators in lots of places. So I would pay attention to all those events and try to make yourself a regular at those events so you can meet people and learn. And then finally, can we have a webinar to explain how to find the best investor group to pitch for your industry and how to scope out potential board members? So obviously the best angel investor group for your entity is going to be the South Carolina Angel Network. Obviously, I'm biased. No, a couple of places you can look. The Angel Capital Association is a trade association we've been big fans of and members of for a long time. They've got a great page that will lay out ACA member groups by region, and so you can see where they are. Certainly, Google is your friend to search for those. There are a number of strong angel networks across the Southeast. We work with a lot of them and have co-invested with them. So depending on where you are, the best advice is to try to find the most local group to you, because anytime you go out and raise capital, one of the first questions you're going to get is, well, did you go to your local angel group and how did they respond to it? So just be aware that question will get asked. So ACA, Angel Capital Association, is a great place to start to look for groups that you might be able to reach out to. Certainly at the South Carolina Angel Network, we can try to help you as well, and we'd be happy for you to reach out to us through our website on our Contact Us page. All right, I think we've exhausted all the questions and we've used up nearly all of the hour that we had. So I'm going to say thank you again. Really appreciate you tuning in. I hope this was at least somewhat helpful. And again, we'll keep these slides available if you want to refer back to those. Certainly, if you have requests for more information, you can reach out to us via our website, and we can try to help you there, or you can submit ideas for future webinars. We'd be happy to take your feedback on that. But again, thank you for your time this afternoon. I hope this was helpful, and we hope to see you in the future on another Venture Carolina Crowdercast. Have a great weekend, everybody. Bye-bye.